Hello, for the session, we are to talk about your investment in associate. So for investment in associate, we are to discuss, of course, your recognition of investment in associate. Next, we are also to talk about your measurement, particularly your initial and subsequent measurement. And also, we are to talk about your presentation of investment in associate. Okay, so let's start first with your recognition of investment in associate. So when do we recognize investment in associate? Of course, if there is a probable economic benefit and that economic benefit is measurable. But of course, before we go further, we need to look into the definition of an investment in associate. So an investment in associate is defined under the standard, particularly PAS 28, as an investment in which the investor has significant influence. So what is important under your investment in associate is the significant influence. So what is a significant influence? A significant influence is also defined under PAS 28 as the power to participate in financial and operating decisions or policies of the investee, but not control. Okay? So it is the power to participate in financial and operating decision or policies of the investee, but not control. So if you still remember when we talk about your equity securities, we have these different levels of ownership. So we have here 0 to 19, we have here 20 to 50, and we also have more than 50%. So if that's 20 to 50%, this is a disputable presumption that you have a significant influence. Because take note, guys, based on the definition, you must not have control. Because if you have control, you are in your more than 50%, then you can already consolidate. But since what we are looking only is significant influence, then we look under your 20 to 50% as a disputable presumption. If this is the disputable presumption, is there any exception on that rule? There is an exception to this rule as your disputable presumption. And what are those exceptions? So we have this mnemonic prime. So under your mnemonic prime, what are the exceptions? First, if ever, even if you have less than 20%, if you are active in the policy making process of the investee, then we can have a investment in associate. Then we have here representation in BOD. We also have your interchange of managerial personnel. We also have your material transactions and the provision of essential technical information. Okay, so our mnemonic again is prime. So first you have your policy making process, and then you have your representation in BOD, and then you have your interchange of managerial personnel. You also have your material transactions, and we have your essential technical information. So even if you have less than 20% ownership, you can still account it under investment in associates. So what is the general rule? The general rule is if you have 20 to 50%, you can account for significant influence than investment in associate. But if in case you have less than 20%, you can still account if we have this prime. Policy making process, representation in BOD, interchange of managerial personnel, material transactions, and essential technical information. So how do we compute for your 20 to 50% ownership? So it is based on your common stock that is acquired divided by your total outstanding common stock of the investee. So the amount of your common stock that you acquired, so common stock of the investor acquired from the investee divided by the total OCS of the investee. If that is within 20 to 50%, then you can account for significant influence investment in associate. Okay, so when do we recognize if it is probable and measurable and you have a significant influence to the investee? When do we see you have significant influence? If you have at least 20 to 50% ownership, but if you have less than 20%, you can still account for it if ever you are under this prime policymaking process, representation in BOD, interchange of managerial personnel, material transactions, and essential technical information, which is provided by the investor to the investee. Now we go forward and we talk about your measurement. So how do we measure your investment in associate? So to measure your investment in associate, again, we need to talk about your initial and subsequent measurement. So what is the initial measurement of your investment in associate? You measure it at cost. So whatever is the cost of your investment, that is the amount of your investment in associate. However, take note for this particular investment in associate, if ever you purchase directly 20 to 50%, you account for it under cost. But what if you purchase it in stages? So what do we mean by purchase in stages? You have less than 20% initially, then you purchase additional, so you have now greater than or equal to 20%. So if it is acquired in stages, so what do? We get first your previously held interest. So this is the less than 20% ownership. You should get it at fair value. You add the cost of new investment. That is your total cost of investment in associate. Okay, so for example, you have here a ABC company has 10% ownership on XYZ company with carrying amount of 500,000. ABC purchased additional 15% for 1.2 million pesos. The fair value of previous investment is 700,000 pesos. Okay, so what is the cost of investment in associate, or what is the initial measurement? Okay, so first we need to get the previously held interest at fair value. So the previously held interest has the fair value of previous investment is 700,000. And the cost of the new investment, so the cost of a new investment is 1.2 million. So what is the initial cost of your associate? 1.9 million. So perhaps you're asking now, what is the treatment of the change from your cost to your fair value? So if ever there is a change on your cost to your fair value, what do we do? So we place that as a gain or loss. But if that particular investment is accounted under FVTPL, we place the gain or loss in profit or loss. If FVTOCI, we place the gain or loss in other comprehensive income. Just take note that your initial measurement depends whether you purchase it directly to get 20 to 50% ownership or you purchase it in stages. When can we say that you purchase it in stages? If ever you have a less than 20% ownership and then you purchase additional, which gives you now greater than or more than 20%. So here in our example, you have initially 10% ownership, and then you purchase additional 15% ownership. Therefore, you have now 25% ownership, which gives you significant influence. Next, we talk about your subsequent measurement. So under your subsequent measurement, we use your equity method. We use your equity method. So under your equity method, we get for your cost first or your initial measurement, plus your share in income, less your share in dividends. So we have these three items that we look into. So cost as your initial measurement, and then share in income and share in dividends. So we already talked about your cost. We talked already about your cost, and that can either be acquired straightly or straight significant influence. So you got 20% to 50% outright or in stages. So less than or less than 20% first, and then you purchase additional, which gives you now more than or equal to 20% ownership. Okay. By the way, on your initial measurement, sometimes you're asked for your goodwill. So what is the goodwill? Actually, this goodwill is embedded on your cost of investment. It is embedded on your cost of investment. Therefore, you don't need to separate your goodwill from your cost of investment. Okay, so sometimes problems will only ask you for the goodwill. To compute for your goodwill, you just compute for your cost times your fair value of net assets acquired. Cost versus your fair value of net assets acquired. So normally what they do is you get first for the difference between the cost and the fair value, and then cost versus cost first, and then you allocate to your other costs. So for example, you purchase 25% of ABC company's shares for 1.5 million. The equity of ABC at the date of purchase is uh, let's say 5 million pesos. Okay, the following assets are understated. So we have land understated by 1 million. We have your inventory understated by 500,000. And then we also have your property or machinery, which is understated by 700,000 pesos. So how do we compute for your goodwill? So generally what they do is you just get first for your cost, which is 1.5 million, less the book value of net assets acquired. So our net assets acquired is 5 million multiplied by 25% because we only took 25%. So 5 million times 0.25%. So we have 1,250,000. 1,250,000. Okay, so the following assets are, so we have 1 million understated, 500,000 over, property 700,000 over. And then we have here your difference. So we have 250,000. So we allocate the difference first. So we allocate it to land, inventory, and your property. So for land, since it is understated, so 1 million times 25%, we have here 250,000. And then we have here inventory of 500,000 times 25%. We have here 125,000. And then we have here 700,000 times 25%. Since it is overstated, we need to add that 700,000 times 0.25, 175,000. So what is the amount of our goodwill? So this is the excess. It is considered as the goodwill. So 250,000 less 250,000. plus 125 plus 175,000. Okay, so our answer is 300,000. This is how your textbooks discuss it. But for me, what I do is I just get for the cost and then I deduct the fair value of net assets acquired. Okay, so I have here 5 million, right? That is the equity or the net asset. And then we have your understated land, so we add 1 million. And then overstated inventory, so you deduct 500,000. Overstated property, you deduct 700,000. So what is the fair value of net assets? So 5 million plus 1 million less 500,000 less 700,000, we have 4.8 million pesos. Multiplied by 25%, we have 1.2 million and the cost is 1.5. So 1.2 versus 1.5, we have 300,000 goodwill. So it's still the same. So it is now dependent on how you will really compute it. You can use this long cut wherein you need to allocate, and you can use the shortcut wherein you just get for the fair value of net assets acquired. So from 5 million, we adjust it to your fair value. Since the land is undervalued, you need to add. Inventory and property is overvalued, so you need to deduct. Okay, so in case you're asked to compute for your goodwill, we proceed and we continue with your subsequent. We said that your subsequent measurement is equal to your cost plus your share in income less your share in dividends. Okay, so we're done with costs. We go now to your share in income. So how do we compute for your share in income? Compute for your share in income, it is your adjusted income multiplied by your percentage of ownership. Multiplied by your percentage of ownership. Okay, so what we do is we get first for your net income, and then we deduct for your amortization. We add or deduct for your amortization, and then we deduct your preference shares dividend. Okay, we go first on your net income. So net income of the associate. You deduct the share of your preference, share of preference. Normally, you deduct this one if it's cumulative or there is a declaration. So dalawa lang yan Pwedeng cumulative lang or may declaration. And then you have these items of amortization. What is this items of amortization? So plus or minus amortization. This is because of the undervaluation or overvaluation. So what are the rules on your amortization? For your land, only amortize it wholly if sold. Land, you will only amortize it wholly if sold. Other depreciable asset, so over the life. Over the life. And then for inventory, once sold. It is considered sold the next accounting period. Okay? So for your amortization, your undervaluation on your overvaluation, if you have your land, you will only deduct that or add it if it is wholly sold. Other depreciable asset over the life, and then we have your inventory once sold. Okay, so let's make use of our example a while back. So let's copy this one. So land, we have here 1 million, which is undervalued. Inventory, which is overvalued. And property, which is overvalued. Let's say the life here is 10 years. And let's say you have here net income of ASOC at 1.2 million pesos. So what is the treatment? So from your 1.2 million, we have here over. So if your inventory is overvalued, If inventory is overvalued, it means that cost of goods sold is overvalued. So what do? We need to deduct here. So we have here amortization of inventory. Why will we amortize the inventory already? Because it is considered sold the next accounting period. So we assume that this is already sold. Now for your property, we have here 700,000 over the life. So we have here 10 years, 10 years. So what we do is we deduct the 700,000, which is for 10 years. So by the way, amortization of inventory, since cost of goods sold is overstated, then we need to add back. Okay. And here, property, it is overstated. If property is overstated, it means that depreciation is overstated. So check it, you need to add back also. So 700,000, so amortization of property, 700,000 divided by 10. So we have 70,000. So what is the adjusted net income? So our adjusted net income is 1.2 million plus 500,000 plus 70,000, we have 1,770,000. So multiply it now to your percentage of ownership, 25%. We have your income or share in income amounting to 1.77 times 0.25. We have 442,500. Or sometimes what they do is like this. First, they get the share in net income. So 1.2 million times 25%. So ganyan yung ginagawa nila. 1.2 times 25%. We have here 300,000. Plus your adjustment on your inventory. So we have here 500,000 times 25%. So 125,000. Plus their adjustment on your over depreciation. So we have here 70,000 times 25%. So we have here 17,500. So total of 442,500. 442,500. So it's still the same. So again, here what we did is we get for the full amount before we affect it on your amortization. Here, we just took the share. We just took the share, which is 25%. So either way, you will still get the same. So again, we have here your cost plus share in income. Take note, the share in income should be added. The share in income should be added. Now, also on your share in income, I will just discuss it. On your net income of associate, we said that we will deduct the share of preference. For your share of preference, you only deduct if it's cumulative or there is a declaration. So in short, your preference shares can either be cumulative or non-cumulative. Cumulative should always be deducted, and non-cumulative should only be deducted if there is a declaration. Okay, why? Because preference shares has a preference over the income. So from your net income of associate, we need to deduct first any income that is attributable to your preference share. Next, we also have on your adjustment on your net income, we have, okay, we already talked so from your on your different items, right? So from your net income, which is unadjusted, we're done with this. And then we have your plus or minus amortization. We already said the rules. And I told you, I already taught you how to compute for it, either with a share only or as a whole. We also talked already on preference share dividend. Now we talk for your intercompany transactions. So plus or minus intercompany transactions. So what is your intercompany transaction? Your intercompany transaction are your transactions between the investor and the associate. Investor and the associate. So we have here investor and we have here your associate. So there are transactions between them. If the transaction is investor to associate, we call this downstream. Kasi nga pababa, investor to associate. If it's associate to investor, we call it upstream. Now, how do we treat this upstream or downstream transactions. Actually, this is still unclear up to this date on how do we treat it. But some authors say that your upstream transaction should only be deducted based on the share. While your downstream transactions, we get for the whole as a reduction. So what do we do here is your unrealized profit plus realized profit. So we have here your total adjustment. So less unrealized profit plus realized profit. So this is your total adjustment. So based on your total adjustment, if that is an upstream, you just get for the share. And if that is downstream, you get for the whole share or 100%. So sa example natin kanina, di ba, 25% ownership. So kunin mo lang from total adjustment times 25%. If that is whole, kunin mo yung 100% as a reduction. So from your share in net income, you either add or deduct the adjustment, either share if upstream, and whole if it's downstream. Okay, so sir, what's this unrealized profit or realized profit? Take note, guys, that you can only recognize transactions if ever it is already sold to third party. So what happens here? We have here your investor going to your associate. If your associate will sold it to third party, then you can recognize it. So if ever it is still within investor and associate, we call this one unrealized. Third party, associate to third party, we already realized it. Take note that unrealized profit should always be deducted at the time of sale. It will always be deducted at the time of sale. Realized profit, it will only increase or it will be added once it is already sold to third party. So for example, okay, so we have here a sale between the associate and investor for an inventory amounting to 500,000, which costs only 300,000 pesos. Half of the inventory was sold to third party. Okay, so sale between the associate and investor for an inventory amounting to 500,000, which costs only for 300,000 pesos. Half the inventory was sold to third party. Okay, so sabi natin yung unrealized profit will always be equal to the amount of your profit at the time of sale. So what is the time of sale? So we have here 500,000 and 300,000. So that is your unrealized profit. So 200,000. And then half of the inventory was sold to third party. Yan na yung realized, diba? From your associate to third party, let's say, or investor to third party. So plus your realized profit. So half of it was already sold to third party. So 200,000, the unrealized profit multiplied by 50%. So this is the realized 100,000. So what is the net adjustment? 100,000 negative. So if that is downstream, so from your share in income, what do we do in your downstream? If that is downstream, we get the whole. So you deduct 100,000 pesos, 100% yan. But if it's upstream from your share in income, we will only get the percentage. So 25% times 100,000. So how much will we deduct? 25,000. Okay, so dito sa upstream or downstream or your transactions between the associate and the investor, this is still unclear up to now. But yun nga, based on this, I will follow the rule that if ever it is upstream, only the share, downstream, whole, downstream, whole. So from your share in income, you get for your adjustment for your intercompany transaction. Okay? So take note, you deduct the unrealized profit. This is the profit on the sale at the time of sale. So let's say year one yan. And then realized profit is any profit that is realized or sold to third parties. So we have 100,000. So out of unrealized profit times sold to third party. Assuming on year two, additional 30% was sold. So do we have unrealized profit? None. Kasi nga, ang year of sale niya lang ay year one. Gets? Saka lang tayo magdededuct ng unrealized profit on the year of sale. So let's say this 500,000 na 300,000 na pasabento ng 500,000 is sold on year 1. So yun lang, at the date of sale lang yan. Year 2, wala na. So year 2, meron daw tayong 30% additional na nabenta sa third party. So how much is that? 60,000. So our adjustment is 60,000 pesos. Ganun yung gagawin natin. Okay? So unrealized profit will only be deducted at the date of sale, while realized profit will be deducted after the year of sale or on the date of sale, depending if there is a realized profit. Okay? Sir, how about if ever I sold a property, plant, and equipment? So the gain or loss on sale is called your unrealized profit. So you need to deduct that. And the realized profit, it will be realized over the life. Okay, over the life of the asset. Or if it's sold, then wholly. Okay. Anyway, this is already higher accounting, if ever. So let's just stick only on your upstream and downstream, the effect. So other items, it will be discussed on your higher accounting. Okay. So particularly on your consolidation for your realized and unrealized profit. But anyway, for PPE, I'm just telling it for theoretical purposes, your gain or loss on sale is the unrealized profit. You deduct that. The realized profit is the depreciation over the life. And if it's sold wholly, then yun, ganun din. So let's say, for example, investor, a property, plant, and equipment is sold between the investor and the associate with book value of 400,000 for 600,000 pesos. The remaining life of the property, plant, and equipment is 10 years. At year 3, the property, plant, and equipment is sold. Okay, so year 1, year 2, year 3. Unrealized profit, realized profit. So our unrealized profit here, so the gain, 600,000 versus 400,000. So 200,000, that is the gain. And we said we will realize it over the life. So what is the remaining life? 10 years. So ang gagawin natin, yung 200,000, i-divide natin ng 10 years. So may realize tayo dito na 20,000, year 2, 20,000 din uli. Tapos once daw nabenta siya, huli na. So 'di ba on year 3, sabi diyan nabenta. Kung 200,000 yan initially, naka-realize na tayo ng 20, naka-realize ulit tayo ng 20 on year 1 and year 2. So what is the balance? 160,000. On year 3, it is sold. It will be now recognized wholly. So 160,000. So what is our adjustment? Year 1, our adjustment is negative 180. Year 2, 20. Year 3, 160,000. And then it will now be dependent whether it is upstream or downstream. Okay? We just need to get for your adjustment. That's for property, plant, and equipment. Okay, so kanina, dito naman tayo sa inventory pag nabenta. Dito naman sa property, plant, and equipment, which is depreciable, then you realize it over the life, but once nabenta, i-realize mo na yung buo. How about for a land? For a land, so unrealized profit at the time of sale and realized profit at the date it was sold to third party. Okay? So let's say a land with a book value of 400,000 was sold between the investor and the associate for 700,000 pesos on year one. The land was sold to third party on year four. Okay, so year one, year two, year three, year four. Unrealized profit and then realized profit. So it is unrealized profit at the time of sale. So what is the time of sale? 1 million. So what is the unrealized profit? It is 700,000 versus 400,000. So 300,000. And then it was realized at the time of sale to third party. In year one, was it sold to third party? No. Year two? No. Year three? No. Year four? Yes. So it will now be realized. Okay, so what are the adjustments? Year one, negative 300. Year two, 0. Year three, 0. Year four, positive 300,000. And again, this will be dependent whether it is upstream or downstream. Further, we talk about your net income. Okay, so we're done with your net income. So for your net income, unadjusted, what are the different items that we need to look into? Share and dividends of PS. So you need to look if it's cumulative, non-cumulative. It's cumulative, always deduct. If non-cumulative, only deduct if there is a declaration. And then we have your amortization. So for your amortization, you have your inventory considered sold at the time or next accounting period. For your property, plant, and equipment, you amortize it over the life. And then wholly if sold. For your land, once it is only sold. Once it is only sold. Next, we also talk about your intercompany transaction. For intercompany transaction, you look whether it is upstream or downstream. If that is upstream, how do we treat it? We treat it upstream, only the share. Downstream, we treat it wholly. We treat it wholly. And take note, what are the items that can be sold? We have, again, your inventory, have your property, plant, and equipment that is depreciable, and land. What is the general formula? Less unrealized profit, less realized profit, and we have here your adjustment. And it's either share or wholly. Okay, so those are the items that you need to look into for your net income. So again, how do we get for your share in income? Share in income is equal to your adjusted income multiplied by your share or your percentage. Okay, so we're almost done with our formula. Our formula is again cost plus or minus share in income less share in dividends. Okay, so we're done with these two items. However, before we proceed further, bakit kaya may minus dito sa share income? Because there might be a loss. And for your loss, we need to talk about your heavy losses. So what is a heavy loss? There is a heavy loss if ever the losses is greater than your carrying amount of investment. So what do we do here is that the investment in associate should be presented at 0. Okay. And what is the treatment? The other losses not absorbed will be presented in your notes, and you can present it as a liability if there is a legal obligation. But if there's no legal obligation, you present it only on your notes that there is an excess loss that is not absorbed by your investment. And if there is profit, what do? We first apply to losses not absorbed, and then any remainder will increase the investment. Okay, so for example, year 1, year 2, year 3, year 4. So the carrying amount of our investment is equal to 1 million. So here are your net income or your loss. So let's say you are sharing 25%. So 4 million loss, 2 million loss, uh, 1.5 million that is profit, and then 2.5 million that is profit. Okay, so how much is the share here? 4 million times 25%. So we have here 1 million. 2 million times 25%, we have here 500,000. 1.5 million times 25%, we have here 375,000. And then 2.5 million times 25%, we have 625,000. So let's follow the rules. If the losses are greater than the carrying amount of investment, your investment in associate should be 0. So we have here investment in associate. If we have 1 million less 1 million, it is 0. Next, we have 500,000. This is already another loss that is not absorbed. Therefore, we'll still present it as 0. And what is the treatment? It will be placed as negative 500,000. That is the balance on your loss that is not absorbed under your notes. And then, if there is a profit, apply first to losses not absorbed. So we have here 500,000 not absorbed. We have 375,000 profit. Sakto ba? Hindi pa din. So 500 less 375,000, we still have a balance of 125,000. So investment in associate is still 0. Next, we have a profit share of 625,000. If there is a profit, apply first to losses. Kasha ba yung 125? Yes. And then the remaining will increase the investment. So we still have 500,000. So 625,000 less 125,000 will give us 500,000. Okay. So if there is a heavy loss, your losses is greater than the carrying amount of investment, your investment in associate can only be reduced to 0. If there are other losses not absorbed, you place it on your notes. But if you have illegal obligation, you place it on your liability. But if there is a profit, you apply first to losses not absorbed. So in this case, look, we have a loss not absorbed at 500,000. We apply first when we had an income on your year 3. And then if there are still remainder, let's say for year 4, we have a loss not absorbed 125. There is a remainder of 500,000. It will increase already the investment. Okay, so that is the treatment for heavy losses. Now we talk about the last item in your formula. So we have your cost plus or minus share in income less share in dividends. So how do we compute for your share in dividends? So this is the dividend declared to ordinary shares multiplied by your percentage. So madali lang yan. So ang gagawin lang talaga natin, if your cost of investment is 1.5 million, and the income of associate is, let's say, 3 million. And then dividend to ordinary shares is 400,000 pesos. So how do we compute for your subsequent measurements? So we have your cost of 1.5 million, your share in income, so 3 million. Let's say you have 25% ownership times 25%. So 3 million times 25%. We have 750,000. And then share in dividend. So we have 400,000 times 25%. So 400 times 25 is 100,000. So what is the balance? 1.5 plus 750 less 100,000. We have 2,150,000. 2,150,000 pesos. Okay, so that's it for our subsequent measurement. Okay, take note the effect of dividend here. Unlike in your dividends before, it is treated as an income. Here, it is treated as a reduction in the investment. Dividend here is treated as a reduction in the investment, unlike in your other dividend income, wherein we treat it as part of your dividend income, or it affects your carrying amount. Okay. Now, we go with your discontinuance of equity method. So when do we discontinue your equity method? If ever you have less than 20% ownership or there is a loss of significant influence. So on your loss of significant influence, this happens whenever there is a sale of investment in associate. There is a sale of investment in associate. So what do we do here? We compute for two gains or losses. We compute for two gains or losses. We have your gain or loss on sale and your gain or loss on reclassification. On your gain or loss on sale, we get for your proceeds on your sale, we deduct the carrying amount of your investment. And your gain or loss on reclassification, we get the fair value of remaining investment less the carrying amount of remaining investment. Okay? So for example, ABC company holds 300,000 shares of XYZ company, which represents 30% ownership. The carrying amount of the investment is 35 million pesos. Half of the shares were sold for, let's say, 20 million pesos. 20 million pesos. Okay? And then the shares are trading at 125 per share at the date of sale. Okay? So we compute for the two items. So for the sale and for your reclassification. So first, we compute for your proceeds. How much did we sell the half of the shares? 20 million. And then what is the cost of the half of the share? So we just get one half out of the carrying amount of 35 million. So one half times 35 million, we have 17.5 million. So we have your gain on sale, which is equal to your 2.5 million. For your reclassification, we get for your fair value of remaining investment. So what is your remaining investment? Kung 300,000 shares yan, binenta mo yung one half, so one half na lang natira. What is the fair value of those shares? The shares are trading at 125 per share. So 300,000 shares divided by 2 times 125, we have 18,750,000. Less the carrying amount of remaining investment. So kung 35 million yan, remaining is one half, 17.5 million. What is the gain or loss on your reclassification? So we have 1,250,000 pesos. Okay, so for your reclassification or for your discontinuance, we have to account for two types of gain or loss: the gain or loss on sale and the gain or loss on reclassification. So take note, we just compare the proceeds with the carrying amount for your gain or loss on sale. For the gain or loss on reclassification, we compare the fair value to the carrying amount of your remaining investment. Okay, so I think we already covered the recognition and also the measurement, including your initial and subsequent measurement. So the last topic for our investment in associate is the presentation of our investment in associates. So how do we present your investment in associate? It should be presented as part of your non-current assets. It should be presented as part of your non-current assets. Okay, so for investment in associate, we first discuss your initial measurement, and then we discuss also your subsequent measurement. Take note on the items under your income and the items on your dividend. Also, we discuss as part of your subsequent measurement the discontinuance of your investment in associate. Further, we talk about your presentation of investment in associate. That's all for this particular topic, investment in associate. Thank you.